Okay, so as we wait for a few more people to join, I'd like to just take us through the agenda real quick. So we'll start with an introduction, and then we'll talk about the previous webinars in this series, and then we'll talk about the landscape of sustainability reporting and non-financial assurance, and then move on to sustainability reporting, methodology, and case studies, and then end with non-financial assurance, methodology, and case studies. And at the end, as I mentioned earlier, we'll have a Q&A session. So please type in any of your questions in the Q&A tab. Thank you. Now I'd like to take a moment to introduce our panelists for today. So our first panelist is Zahir Sheikh, who is from BDO East Africa. He's a partner in risk advisory, internal audit, and forensic services at our offices here with over 30 years of experience, including a significant tenure at KPMG East Africa and executive services in the UK. He has led high public profile assignments in internal audit, fraud investigations, data privacy audits, and ESG services. At BDO East Africa, Zahir has conducted over 40 webinars and established strong internal audit, forensic services, and risk management practices. As regional partner of advisory services business unit, Zahir has provided advisory services on corporate governance, ethics, ESG, led forensic investigations, and testing and designing internal control systems. Zahir also manages the firm's carbon footprint initiative, demonstrating his commitment to environmental sustainability. Zahir's efforts have significantly promoted ESG principles and established the BDO brand in the Eastern African region. Our next panelist is Indra Guha. He's a partner in the Sustainability and ESG team of BDO Advisory Services in BDO India. He has over 25 years of professional experience in the domain of sustainability, ESG, and climate change. He focuses on making sustainability actionable and measurable, advising organizations on developing vision, goals, targets, and roadmap on sustainability, assisting with identifying risks, opportunities, and integrating ESG into enterprise risk. Indra has worked across diverse industry sectors and with the government, IFIS, and NGOs. Apart from extensively working in India in the Indian market, he has also engaged with multiple businesses associated with the Middle East, Europe, and Southern Asia. And now I'd like to introduce Prateek Singh Gupta, who is a director in the Sustainability and ESG team of BDO Advisory Services at BDO in India. He has 12 years of professional experience in the domain of sustainability, ESG, and climate change. Prior to BDO, he has worked primarily in the space of ESG, sustainability, and climate change, consulting with global firms. He has supported several leading Indian and global companies in designing their ESG and sustainability strategy, preparing their non-financial disclosures, leading non-financial assurance engagements, and provided training and awareness generation on corporate ESG and sustainability. He has also worked extensively with donor agencies like UNDP, GIZ, and the World Bank in developing climate strategies and securing climate financing for several states in India. He also helped build the ESG and sustainability team at a leading Indian airline company from the ground up. So thank you all for joining us today. And now I'd like to hand it over to Zahir Sheikh to introduce BDO to us. Thank you.
Thanks, Meha, and a very good afternoon or good evening or good morning, depending on where you guys are joining us from. We're very happy to be with you all today, and we're looking forward to a very exciting session. As usual, I want to take a little bit of time just to talk about BDO before we actually jump into the webinar. So BDO is a global audit and advisory firm. We are the 5th largest globally. Last year, our revenues exceeded $14 billion. We have a presence in 166 countries globally with nearly 1,800 offices and in excess of 115,000 professional staff. We provide 4 services, which is audit and assurance, advisory, tax, business services, and outsourcing. Next slide, Meha. Right. So just a little bit about the services we provide. We act as statutory auditors or external auditors for a whole range of global companies, regional companies, as well as local and private companies. We're particularly strong in the family-owned businesses sector. We also do special audits for donor-funded projects and special purpose audits. We provide training on IFRS and other technical accounting standards. On the tax side, we have 2 divisions. One is compliance. So we do all of the tax compliance, for example, your returns and so on and so forth. And then the other one is a advisory services department, where we provide advice on transfer pricing, taxation, including expatriate taxation, corporate tax planning, including international tax planning, indirect taxes, customs duty, and so on and so forth. We also have a very good track record of dealing with disputes, particularly with revenue authorities in various countries, and our track record is quite good in that area. And then we have a business services and outsourcing center in most countries in which we operate, which means you can outsource some of your services to us if you don't want to do them yourself. For example, things like bookkeeping, accounting. We use software packages like QuickBooks, Xero, and so on and so forth. We can compile your annual accounts, statutory accounts for you, put them together. We can do management reporting for you. We can provide fiscal management services. We can handle your payroll services. We act as company secretaries for several hundred companies, where we file all of their returns. We also provide legal advisory services. And then we have the advisory services unit, which I head for East Africa. And within that, we provide outsourced internal audit and risk advisory services. So typically the saving there could be up to 70%, depending on how big your internal audit department is. And then if you want to outsource that, so just keep maybe 1 or 2 staff, and then the rest of the work can be done by companies such as ourselves. We also provide management consultancy services. We have a business turnaround or corporate recovery division, which looks at ailing businesses, receiverships, administrations, and so on and so forth. We have a deal advisory team, and in fact, we do more deals than any other organization globally. So we actually are market leaders for transactions and deals worldwide, just in terms of the number of transactions. And then we also have a forensic division, which deals with frauds and fraud investigations and helping companies to prevent fraud in the first place. And then we have a technology advisory division that looks at all IT solutions, including AI. We also provide business intelligence, data privacy services, and then, of course, what we are doing today, which is sustainability services and ESG. Next slide, please, Meha. So if we look at where we've come from, we started this series, this 4-part series, on the 24th of April. And our first part was demystifying the ESG process. In this session, we broke down what the ESG process is into understandable steps, making it easier for everyone to grasp the basics. And like Meha said, if you missed any of this, please go to our YouTube channel. Simply type BDO East Africa when you're in YouTube, and you'll see our channel, and you'll have access to more than 50 webinars. So please register with us, subscribe to our channel, and then you'll get a regular update of all of our training material as and when we do that. And then in our second webinar, which was part 2, we talked about prioritize materiality assessments and stakeholder engagement. And in this session, we focused on identifying what is most important to your organizations and also how to effectively engage with stakeholders. And then at the beginning of July, on the 2nd of July, in our third part, we looked at access. which is basically creating an ESG roadmap. We talked about how to develop a clear and actionable plan to integrate ESG principles into your business operations. And today we're doing the final part, and we're covering a number of things in this part. So today we're going to talk about report and measure. So we will be talking about preparing and submitting sustainability reports and determining limited and reasonable assurance of sustainability reporting. We will cover the essentials of reporting, measuring your ESG efforts, and also at the same time ensuring that these are done in a transparent and accountable manner. So without further ado, let me hand on to my colleague to take you through the rest of the session.
Thank you, Zaid. Thank you, Meha. And thank you, everyone, for joining in. Welcome to this session of another round of sustainability discussion. So as you can see on the screen, these are some of the services that from BDO we have under the umbrella of sustainability. And today, my colleague Pratik and myself will take you through some of the specific areas as Meha has already described. But before we get into these topics, let me share with you a little bit of snippet of what we all do under this. If you look at some of the specific bullets under each of these panels, the first one you'll see on ESG diagnostics, framework and strategy. This is about understanding the business value chain, understanding the priorities of business from the non-financial performance count, from the non-financial risk count, and laying out a roadmap for business in the longer term. In a 5 to 10 years horizon, what should a business do in order to address all its non-financial agenda, how to address all the stakeholder agenda, and work in a sustainable manner to ensure sustainability not only of the business, but all the stakeholders in the value chain that it interacts with. So that's the first block of area that we work under. The next one that you see just below that is talking about disclosures and assurance. This is something which we are going to detail out in today's session. We'll be talking about the reporting frameworks, how we go about it, what is the methodology that one needs to apply. And this is where we engage with businesses across sectors in helping them disclose under different frameworks that they need to disclose upon. And these are all driven by different stakeholder groups. Sometimes it is the investor, sometimes it is the customer, sometimes the entire regulatory framework. They may be asking for certain disclosures around certain frameworks. So that is where we come in with help. And non-financial assurance is something which increases the credibility of whatever you disclose. And this is where we are accredited also under AA 1000, Accountability 1000. And we provide external assurance to the disclosures that go out in the public domain. The third block, next in line, you see it is talking about ESG risk, resilience, and performance improvement. This is where we assess what are the risk exposures, and we integrate the non-financial risks or the ESG risks into the enterprise risk management framework, into the ERM framework. And we help organizations improve performance on some of the rating platforms under ESG. We have Dow Jones Sustainability Index, DJSI, Morgan Stanley Index, MSCI, FTSE Russell, then PSI. All these are specific platforms where organizations or businesses get rated on their sustainability performance. We help organizations through this, through our engagement process, help them to report under these specific platforms and get a good score and perform well over there. And we do the entire internal capacity building as well under this. The subsequent one that you can see, it is talking about digital solutions, which is basically technology solutions and platforms to manage the information on ESG. And it is one of the most critical aspects nowadays, which is actually driving organizations to set up specific software, specific tools by means of which they can actually manage the data across the organization, across the different manufacturing facilities, and consolidate the data for appropriate disclosure as well as for assurance. The next one you can see is on sustainable value chain, which talks about beyond the gate to gate. It talks about the entire value chain and the partners in the value chain. There, what we do is we assess the ESG performance across the value chain of the supply chain partners and as well as in the delivery chain, both upstream and downstream. And we help organizations address issues in their value chain also. There are quite a few risk exposures from the value chain, and sometimes it is very critical. Some of the businesses, they have a very high risk exposure from their value chain ESG risk exposure. That is what we help them map, and we help them address those issues. If you move on to the panel at the center, we are talking about climate action, resilience and neutrality, and sustainable energy. These two go hand in hand. The first one purely focuses on the climate risk assessment and climate scenario analysis, and also disclosures around climate risk and scenario. This is becoming important day by day, and there are certain global frameworks on TCFD, and SBTI is also giving us some net zero pathways, which is becoming very important, and the stakeholders are asking for net zero roadmaps or low carbon roadmaps from businesses. So that is where we help organizations to set their low carbon roadmaps and align to some of these global frameworks. And sustainable energy talks about, which is quite obvious, talks about the energy efficiency and both from the demand and the supply side. And we talk about a footprint which is going to be much more cleaner and greener, and which will dovetail with the climate action agenda that the organization designs for itself. On the extreme right, you can see sustainable healthcare and government and IFI related solutions. Under healthcare, what we try to do is we try to connect the dots between climate change and sustainability with the long-term health impacts on human society. And we try to develop solutions, which mostly nowadays it is being taken up by some of the leading global organizations like WHO, World Bank, IFC. They are driving some of these solutions, and we help them develop the solutions and also execute certain engagements on behalf of these large global organizations. Under the government and IFI, we engage with the ministries and the government in order to help them frame certain policies and frameworks, which will be working as enablers to sustainability initiatives in a particular geography. So this gives us the broad and the complete set of solutions that we take to our partners in the market, and we help them go through this transition roadmap, which is not an overnight exercise. Any initiative on sustainability, it's not an overnight exercise. It is always small steps towards the right direction, and that is what we prefer to be. We remain as partners to our clients in order to take them through this maturity curve along better performance on sustainability and ensuring sustainable performance across the value chain. If we can move to the next slide. Now, I will request my colleague to come in. So what we'll do is we'll split it between Pratik and myself. Pratik will take you through the recap of the previous webinars, and we'll also share with you stuff on reporting. So inputs on reporting, what are the frameworks, how to go about that, what is the methodology. While I'll be speaking majorly on the assurance part, what are the frameworks, what are the standards, and how one needs to go about doing that. So Pratik, over to you from here, and I'll step in once the assurance piece comes.
Thanks, Indro. Thanks so much, Meha and Zahir, for the introductions. And thank you all for participating today. So Zahir's already covered, what we have talked about in the previous webinar, so I won't spend too much time on this. And also, as Meha mentioned, we do have a dedicated YouTube page where you can see the recordings of the past webinars in this series. In the first webinar, we, of course, it was called Demystifying the Entire ESG Process. This was a high-level overview of what exactly ESG is, what it means to businesses, what are the various frameworks that are in place for ESG, and how companies are navigating this. We can move to the next slide, Meha. In the second webinar, we talked about materiality assessment and stakeholder engagement. This is a very critical topic, even for today's discussion, because materiality, as we discussed that day, is the first step in preparing non-financial reports. It literally lays down the foundation and the framework that dictates your disclosures. And in this session, we covered how stakeholders are identified, how they are mapped, how they're engaged, how the double materiality process is conducted, and what has been the evolving sort of landscape when it comes to materiality globally. And in the third webinar, the one prior to this, we talked about how to create an ESG roadmap. This, of course, is something that is of great importance to many companies and many stakeholders. How do I actually go from having absolutely nothing in place to creating something that is actionable and practical, and as well as meeting the requirements of various ESG frameworks. So that session covered how we operationalize an ESG strategy, how we do a maturity assessment to understand where we stand, to decide what the next steps would be, and then how that process then feeds into creating a long-term ESG roadmap and identifying various initiatives that you would have to undertake over a period of time to move from a low level of ESG maturity towards a higher level of ESG maturity. So coming to sustainability reporting and non-financial assurance. So as Indro mentioned, I will take you through the portions on reporting, and Indro will come in during the assurance part. So let's start with what is sustainability reporting. I think this is a concept that most of us today are familiar with. Most of us would have either worked on a sustainability report or been part of an organization that publishes one, or seen some other organization's sustainability report in the public domain. So this is something that maybe 20 years ago was a rare phenomenon. Today it's absolutely not a rare phenomenon. Literally 40,000 sustainability reports are published annually around the world. So therefore, this is no longer something that is a mystery to people. Very simply put, sustainability report is a disclosure, whether voluntary, solicited, or required, of non-financial performance information meant for external stakeholders of the organization. What this means is, we all understand what an annual report is. It contains all our financial information. This is basically the non-financial version of that, where we identify key metrics, key KPIs under ESG, compile the data, and then present that information in a manner that is following certain reporting principles like accuracy, completeness, reliability, etc. We will get into those in greater detail later on in this session. Some of the benefits of sustainability reporting, I think these are also something that is self-evident. Improve risk management. Risk is something that Indro touched upon a little bit earlier. ESG-related risks are a growing concern for all companies. Companies, of course, have always been cognizant of traditional risks like financial risks or technology risks, but ESG risks are something that have gained a lot of prevalence in the last 5 to 10 years, and most large companies have a dedicated team looking at ESG risk mitigation, and publishing a sustainability report helps companies in mitigating some of those risks, because it puts information out in the public domain, therefore increasing the credibility of the company itself on an ESG front. And it also provides valuable information to critical stakeholders like ratings providers and your investors, shareholders, etc. Optimize costs and savings. This is again something that we've seen. One thing to note here is reporting itself is not the journey. Reporting is the culmination of a journey. So sustainability reporting, is sometimes treated by companies as a project in and of itself, which is okay. But ideally, the sustainability report should be published after a series of activities have been undertaken and you have something substantial to disclose. And it's not just about data, it's not just about metrics, it's about your strategy. What are your goals? What are your objectives? What are the challenges? What are the opportunities that you're facing? What are your strategies that are in place to sort of mitigate these or take advantage of these? So that's what needs to be disclosed in an effective reporting manner. And what we've seen is companies who've been publishing sustainability reports for 10 years, 15 years, they definitely see a huge reduction in costs, and an increase in savings as they go ahead. Because once you start collecting, data on your energy consumption, on your water consumption, on your waste disposal, automatically you will realize that there are so many areas where efficiency can be brought in, costs can be reduced, and there can even be potential for a future revenue stream. So for example, with waste disposal, when we talk about the circular economy, selling your waste to another company that can use it as an input. So all of these opportunities only will come about once you start the reporting process, and you can start collecting data and identifying what needs to be done. Also, of course, better stakeholder engagement. Stakeholder engagement is the first step as well as the last step of reporting. Stakeholder engagement directly feeds into your materiality and therefore feeds into your report. But also, the report is targeted at your stakeholders. You're publishing the report in order to meet certain stakeholder expectations. So coming to certain region-specific ESG frameworks, we touched upon this, of course, in one of our priors in the first session that we did, but it's good to recap again. So uh, I think for the audience here, mainly from the East Africa region, the Nairobi Securities Exchange ESG reporting requirements is something that I'm sure many of you are familiar with. Then there's of course the Capital Markets Authority ESG requirements that have also kicked in. From 2015, it requires listed companies to explain in their annual reports how they have applied the recommendations in the code. There's, of course, also the United Nations Global Compact. More than 200 companies in Kenya are participants of the Global Compact. And this is something that is very essential in driving non-financial disclosures, because UNGC does require companies to put out a communication on progress disclosure every year, and it's not as detailed or comprehensive as a full-fledged ESG report, but it definitely puts companies on the path towards publishing a full-fledged ESG report. And of course, there are several investor groups, as I touched upon earlier, that are driving the move towards ESG-related disclosures, because they want to assess, companies' performance not only on a financial front but also on a non-financial front, in order to effectively gauge the risk of investment before they do so. And right now, we're seeing this evolution taking place where large-scale institutional investors are unwilling to go to companies for investment who are not putting out their disclosures in the public domain. And if you see some of the statistics on the right-hand side, only 1 in 4 Nairobi Securities Exchange listed firms are compliant with the ESG reporting framework. So there's definitely a lot of room for growth in the region in this space. 15 out of the 61 publicly traded firms have adopted ESG disclosures following the release of the guidelines. So again, even in the public sector, we are seeing a very slow uptick. So there's definitely a lot of space for growth in the East Africa and Kenya markets. So what you see on your screen are basically a summary of findings of a report on sustainability reporting and assurance that was compiled and published by IFAC and AICPA, as well as SEMA, who are sort of the leading authorities on non-financial assurance and financial assurance globally and reporting. What you see on your screen is, the summary of that study. They surveyed 1,400 companies across 22 different jurisdictions to gauge the level of, reporting that is currently occurring. So if you see, the rates are quite high in many geographies. In North America, it's 100%. In Mexico, 99%. In the US, 98% in Canada. Again, if you look at Australia, it's 100% over there. If you look at Europe, again, the rates are 100% in all the major countries over there. In India also, the rates are very high at 100%, and in other Asian geographies like Singapore and Indonesia also, and Japan. In Africa and South Africa, data was not really available for East Africa, but in South Africa, we see 100% of the companies that were surveyed, they were publishing sustainability reports. So this is something that is now a global trend. Like I mentioned before, sustainability reporting is no longer a niche concept. It's not some unique thing that a few companies here and there do. It's now becoming a matter of routine practice for all major companies around the world. And from that same report, some of the trends that we're seeing on what is being reported. So 97 of companies that were surveyed disclosed information in, four key topic areas, greenhouse gases, other environmental, social, and governance aspects. And if you see the spread, greenhouse gases, 92% of companies in 2020 reported on their greenhouse gases, and that has increased to 98% by 2022. If you look at other environmental parameters like water consumption, waste disposal, this is again something where reporting is very high. On social, again, aspects, again, the reporting, compliance is very, very high. On governance as well, and on all topics as well. But the one stark thing that you will notice is there has been a significant change in just the last 2 years. From 2020 to 2022, uh, it went from 89% to 97%. So that means that there has been some significant driver that has driven companies more towards ESG. And of course, this has been the pandemic that we all suffered through that period, and that has been one of the critical reasons why many companies have now started disclosing on information and started disclosing information that they were not disclosing earlier. These are again certain statistics. So trends in sustainability reporting. If you see the kind of reports that are coming out, so sustainability reports can be of many types. They can be standalone sustainability reports. You can have sustainability disclosures within your annual report. You can have an integrated report which combines financial and non-financial disclosures, and of course you could have no report in place. So again, if you look at the numbers, in the numbers of the vast majority of the disclosures are coming in the form of integrated reporting, or it used to be sustainability reporting, standalone sustainability reporting, but now we are seeing that companies are now more and more going in for integrated reporting in the advanced geographies. That means they're combining the financial and non-financial disclosure. And this is a trend that we've seen in many geographies, including in India, in Europe, and in North America. And if you see the adoption of reporting standards and frameworks, so GRI, of course, is the parent framework for most non-financial reporting frameworks. It has a very high rate of adoption. SASB has a lower rate of adoption. SASB used to be something that was only applied by companies that operated in the US, but now many companies outside of the US are also adopting SASB because they provide 77 sector-specific frameworks for companies, which companies find very practical to sort of apply to their reporting requirements. SDGs, of course, this is something that we've seen an increased uptick in. Whatever framework companies use for developing reports, generally they tend to link their reporting to the UN Sustainable Development Goals. TCFD-based reporting, which is the Task Force on Climate-Related Financial Disclosures. This reporting is something that has picked up significantly in the last 3 or 4 years. Where it was at 12% in 2020. It's now almost 92% of the surveyed companies are providing TCFD-based reporting. So this is good. This goes to show how important identifying and disclosing climate-related risks have become in today's environment. And yeah, and of course there are most companies do adopt a combination of frameworks while developing reports. Some of them can only use either one framework, but in most cases we see either it's GRI and TCFD and SDG combined, or GRI and SASB and SDG combined. So most reports use a combination of frameworks, but definitely one framework remains the underlying foundation, and then the other frameworks are sort of linked to it. Yeah. So I'll hand this back to Indro now.
Yeah. Thank you, Pratik. Thank you for explaining the entire reporting framework and the journey that an organization needs to take up. Moving on from there, we are going to look at assurance, which is basically enhancement or augmentation on the credibility of whatever disclosure we are preparing for ourselves. So whenever we are coming out with a report, it is meant for the external and internal stakeholders. It is meant for someone to read. So enhance the audibility or enhance the the value in the minds of the reader. That is what an external assurance does for the non-financial disclosure. So we all know that for financial statements and all, the assurance process has been for a very long time. For decades, it has been in place, and it is very, very standardized, and it's a routine process of how one needs to audit the balance sheet and the P&L. But for non-financial disclosure, the assurance process is developed over a period of time, and there were a lot of experimentation of how and what kind of a process needs to be applied for auditing or verifying the non-financial performance parameters of an organization. So when we look at the rationale for conducting assurance, as I was telling you, that these are some of the, if you look at the left-hand side, the diagram that you have over there, these are some of the drivers for going in for or choosing external assurance. There are most of the organizations nowadays that are reporting. We'll look at the numbers as Pratik also showed in one of the surveys that were conducted. So we'll look at some of these numbers, but most of the reporters nowadays prefer to go for an external assurance just because of some of the specific needs from different external stakeholders, as well as it also creates or paves the way for a continuous improvement in your sustainability journey or in your disclosure journey. So you look at the angle of social injustice, look at the angle of investor trust, sourcing or the supply chain sustainability, then looking at ethical business practices. Now, when it comes to declaring on each of these areas under sustainability reporting, following the principles given by all those global standards that Pratik shared, GRI, SASB, and SDG and all. So any organization can declare on its own behalf. But the moment it goes through a screening, goes through a third eye verification, and ascertaining statement saying that, yes, whatever the organization has declared and stated in the disclosure, it's reliable and it's auditable and it's some kind of a transparency and auditability and consistency, it is getting verified through an external assurance, then definitely it adds much more value to the disclosure. And that is what is being guided. If you look at the box at the bottom, the two boxes at the bottom of the slide, it talks about this assurance being guided by some of the global guidelines right from the very beginning. When GRI came into play in 1999, 2000 was the first version. It recommended that any non-financial disclosure, ESG disclosure or sustainability report ideally should be verified by an external party to ensure that whatever disclosure goes out in the public domain is a credible one. If we can move to the next slide. Now, there are different types of assurance. As you can see by the title of the slide, it talks about a limited assurance and a reasonable assurance. These are taking us a little bit deeper into the entire assurance process. Now, this is more from the point of view of the organization, which is going to provide assurance to the ESG disclosure or the non-financial disclosure. So an assurance provider or an organization who is providing assurance, they can provide assurance under limited assurance criteria or reasonable assurance criteria. And these are different in a way that reasonable assurance increases the risk magnitude for the assurance provider. So a provider of assurance who is providing assurance as per reasonable assurance criteria is actually taking up much more liability of the disclosure that is going out into the public domain. And while limited assurance, the risk of the assurance provider is much lower. And this has been the most widely used, widely accepted, and because the effort level is much lower, both from the assurance provider point of view, as well as the reporter point of view when it comes to evidence gathering process and evidence providing process. The entire effort in the entire process of limited assurance, that is much smaller compared to a reasonable assurance process. So if you look at the points of difference, you can find these things that I'm mentioning. You can see in the first point it mentioned the practitioner meaning the assurance provider, reduces the engagement risk to a level that is acceptable in the circumstances of the engagement. Now, under reasonable assurance, it is adding the word acceptably low level. So the risk for the assurance provider has to be reduced to a marginally low level. So that means the evidence gathering procedure. If you move to the second point, the second line, you'll find the way of actually addressing this. So the moment I have to reduce the risk from the assurance provider point of view, the evidence gathering process has to be much more exhaustive. So that happens for a reasonable assurance, where it says that it needs a much more extensive evidence or audit trails that needs to be established. Whereas under limited assurance, if you look at the left panel, you can restrict it to limited number of samples. Even you can restrict it to 20, 25%, 30% of the sample. Whereas under reasonable assurance, in some cases, the assurance provider may even go up to 70, 80% of the entire sample size of evidence trails for completing the audit. Depending on the risk, depending on the sensitivity of that particular issue, the assurance provider will use its own judgment in order to arrive at the sample size. And in some KPIs, for some indicators that get disclosed, the evidence trail can even consider 70, 80% of the sample audit trails. It is less rigorous when it comes to limited assurance, and many a time the nature of evidence that kind of gets accepted by the assurance provider, it can be through discussion, it can be through emails. But in case of reasonable assurance, the assurance provider has to go right up to the systems, processes, right up to the point of generation of data, and it will have to check what are the risks of failure, risks of error that can creep in the entire cycle of data transmission and data capture. So that way, at a high level, you can assume that reasonable assurance process is much more extensive, both from the assurance provider as well as the reporter point of view. It is much more costlier because naturally the effort increases, the cost also increases along with it. Whereas in limited assurance, the cost is lower and the effort is also much lesser. And till now, the trend has been mostly, if you had looked at 80, 90% of the reporters, they had adopted limited assurance. But slowly, gradually, there is a shift. And in many countries, in many geographies, it is getting mandated that one should go for reasonable assurance for some KPIs, which are very critical from the non-financial, from the ESG point of view. If there are critical parameters for a particular business in a value chain, they need to go for reasonable assurance for those indicators. That's the kind of mandate that is slowly shaping up. In India, the government has actually mandated, the Securities Exchange Board has mandated that the organizations which are in the top 1,000 by market cap, they'll have to get reasonable assurance done for 22 core criteria that they have specified, which includes indicators. Indicators come to around 46 indicators they have mandated, which will be covered under reasonable assurance. If we can move to the next slide, Maya. Now, this slide talks about the different principles of one of the assurance standards, which is ISA 3000. This is one of the very old assurance standards, and it is an umbrella assurance standard, you can say. And under that, there are ISA 3402 and 3410. These are the two sub standards that are there under ISA 3000. And 3410 talks about assurance of greenhouse gas treatments, whereas 3402 talks about assurance on the controls of the organization, the checks and balances and the controls that you have, that is dealt with by 3402. And if you look at the principles of assurance that under IC 3001 needs to look into are relevance, completeness, reliability of the information and data, neutrality, balance. So we need to balance it out. We need not highlight something which is only a goody image of the organization, but everything that gets stated, it needs to be well balanced. And we also need to disclose failures with equal weightage, and there needs to be a plan around that. And understandability. So everything that gets disclosed in the report should be understandable by the reader, and there should not be any kind of complicated story shared in the report which does not get appropriately interpreted by the reader, or there are chances of misinterpretation by the reader. And when the assurance process happens, the assurance provider has to look at the accuracy of data, the accuracy of the report content, and integrity of the management processes that are there in the way of preparing the report or consolidating the data and the information. And when it finally comes to delivering the assurance opinion after conducting a thorough review, conducting audit trails, when the assurance provider is actually issuing the statement, the signed statement which qualifies the report, it will be taking into consideration two things. If you look at the bottom right corner, you'll find two things highlighted in bold. One is the sufficiency of evidence or the quantity of evidence, and the appropriateness or the quality of evidence. So both these things will get considered when it comes to final issuance of assurance statement. So the assurance provider will need to collect under reasonable assurance a substantial amount of audit trail or evidence trail to substantiate its opinion. At the same time, the quality of evidence cannot be rudimentary or basic under reasonable assurance. It has to go deep down, and it has to collect the right amount of evidence, even going back to the logbooks and the raw data collection points. It cannot be reliant on maybe emails and Excel sheets getting compiled at a certain place. It has to be a system-based approach which needs to be considered while considering the issuance of the final signed assurance statement by the assurance provider. Meha, if we can move to the next slide. Now, there is another assurance standard for non-financial performance, which is Accountability 1000 Assurance Standard, which is also a very well-renowned assurance standard for non-financial information and report. And this talks about four principles. It talks about principles of inclusivity, responsiveness, materiality, and impact. So when the assurance provider provides the statement at the end, it has to talk about these four principles. And if you look at the description of the four principles, if you look at the four boxes at the four corners, it describes what exactly it means by impact. Organization, by impact, it means organization should monitor, measure, and be accountable for how their actions affect the broader ecosystem. So it is the outward impact of the organization's value chain, and the organization need to be mindful about assessing the impact that it is creating in the outside ecosystem. Talking about responsiveness, what does it mean? It means the organization should act transparently on material sustainability topics and their related impacts. It should be responsive. It should be responsive to the specific issues. It should be responsive to the specific stakeholders. And the response mechanism, suppose if we are impacting the external environment in a particular way, be it through my emissions, be it through my water, the wastewater that I'm generating, I need to respond to this particular impact that I'm generating very promptly. And we need to take up certain measures, certain mitigation actions appropriately and in a timely fashion. So that is what responsiveness need to look into. Inclusivity, what does it mean? It means people should have a say in the decisions that impact them. So the stakeholder groups need to be considered, and all their issues need to be considered by the organization in capturing the issues that they're reporting. So if I ignore some of my stakeholders, if I ignore some of the issues that are very relevant for some of my key stakeholders, then my reporting is not transparent. I'm ignoring something very material, ignoring some of my stakeholder concerns, and the report should be considered as incomplete, and the assurance statement needs to capture that in the assurance opinion. Similarly, for materiality, which most of us would be aware of, when we are not disclosing information on any of the material topics that has been identified, or we have not identified a material topic for the business, then we are omitting something which is material for the business, for reporting the non-financial business performance, and that needs to be highlighted in the assurance statement. So that way, AA1000 is a very, very comprehensive assurance standard on non-financial performance, and it captures and presents. If you look at some of the samples in the public domain, you can just do a Google search, you'll find a lot of samples. So it actually captures the opinion on all these 4 principles when it is providing assurance to a disclosure. If we can move to the next slide, Neha. Now, there are different types of assurance under AA1000 as well. So I talked about limited assurance and reasonable assurance. So there are, again, 2 types under AA1000 also. It is called type 1 and type 2. Under type 1 assurance, it is only going to look at a disclosure from those 4 principles that I mentioned in my last slide. The principles of materiality, inclusiveness, responsibility, and impact. It does not look at the data, the veracity of the data, the accuracy or consistency of the data. There is a type 2 assurance under AA1000, which looks at the accuracy and reliability of the quantitative data that is presented in the report. Generally, if you look at all the assurance statements coming out under AA1000, generally organizations prefer to go for type 2 assurance, where it covers both the data as well as the principles. While type 1 only covers principles, type 2 covers both data as well as principles. So organizations prefer to go for type 2. And under both these types, there is a high level and a moderate level of assurance. High level and moderate level, I don't need to explain any further. High level corresponds to reasonable assurance, whereas moderate level corresponds to limited assurance that I explained earlier in my previous slide on ICA 3000. If you draw a parity between ICA 3000 and AA1000, high level under moderate corresponds to reasonable assurance, and moderate level under AA1000 corresponds to limited assurance under ICA 3000. The only thing, type 1 and type 2 is something which comes in under AA1000. Type 2 covers both data as well as the principles, whereas type 1 only covers the principles that I mentioned in the previous slide. Yeah, we can move to the next. Coming to the same map that Pratik had mentioned, but this talks about the coverage under assurance. And if you look at some of the countries, they have really gone in for a very extensive level of assurance. So some of the countries in very dark green, you can see they are almost 100% of assurance is done for all the non-financial reports. You look at India, China, and some of these countries which are there, they are not so much, not so high on the assurance count. Around 50-60% of the reporters are getting it externally assured. Whereas all these gray patches that you are seeing, we don't see too much of a assurance done over there. You can see South Africa very high from the assurance point of view. But generally the other areas of Africa, the assurance level is very low. Now, the moment we are shifting towards more of disclosure, so the disclosure was also low in some of these geographies where you are seeing low assurance. So the moment we are thinking of disclosure and moving into disclosure, I'm sure that the assurance percentages are also going to increase over a period of time. It does not happen overnight. In some of the countries, it took over 3 to 4 to 5 years time to kind of embark into assurance process. Many reporters, they carry on with reports for 2, 3, 4 years at a go, and after that, they decide to go for external assurance. But external assurance is very, very beneficial, not only as some kind of an audit that gets done and the scorecard and the score that you kind of find out in the assurance statement, but it actually provides a lot of input for improvement in the reporting process. So most of the reporters who have gone into assurance right from the very beginning, they have improved faster in the track to matured reporting. So it is advisable to go for assurance. It gives a third-party view, and it provides you with a lot of pointers to improve in the entire process. I'll describe to you more about what are the deliverables under assurance, standard deliverables, which will tell you how it adds value to the entire advisory cycle on reporting. We can move to the next slide. This is something on the numbers and stats. So if you look at the scope of assurance, you can see more and more companies, they are focusing on assurance on their carbon emissions or greenhouse gas emissions. So there are 6 greenhouse gases identified Kyoto Protocol. So these greenhouse gases, which are the primary reasons of global warming, they are under focus, and it is increasing every day. The assurance of these greenhouse gas emissions, that is increasing. Environmental data is also quite high on the assurance point. Social data, it's a bit lower on the lower side, and governance and the other topics, they come even lower. If you look at the standards of assurance, the maximum amount of non-financial assurance is provided under ISA 3000. And as we can see that the proportion has varied over the years. And some of the standards like ISO 14064, particularly for greenhouse gas, most of the organizations are slowly getting aligned to that ISO 14064 also. But if you look at ISO 14064 and GHG protocol, if you look at it from the GHG accounting point of view, there is not much of a difference. And on the assurance point of view, IEC 3410 is very, very strong and a very, very robust assurance standard for greenhouse gas emissions. And most of the global entities that we are seeing who are asking for assurance on greenhouse gases, they prefer to use IEC 3410 as a seed. If you look at the 3 circles at the bottom of the slide, talking about scope 1, 2, and 3 emissions, out of these companies who were under the survey, we could see that scope 1 and scope 2 emissions were assured by all of them, all of the companies, while scope 3 emissions were not assured for more around 40%. So 60% of the companies, they have got the scope 3 emissions assured, which is beyond the boundary and outside their own control, which most of you be aware of. Yeah, Mia, we can move to the next slide. Now, this talks about greenhouse gases assurance by the scope. And if you look at the color coding at the bottom, so the scope 1, 2, 3 emissions are getting assured by in some of the countries at an equal level. And in many of the countries, it is only scope 1 and 2 which are getting assured. So if you look at the gray patch, if you look at the overall diagram, and if you look at the gray patch, so the gray patch is very high in many of the countries. So which tells us that scope 1 and 2 emissions, which are easy to kind of assure, they are getting assured in many of the countries, and only some of the countries like say France, I can see, and Italy, I can see, and South Korea, I can see, which are covering all the scope 1, 2, and 3 emissions under assurance. Right, Maya, if we can move on. Yeah, so this statistics actually tells us that limited assurance, reasonable assurance, and moderate, where exactly which countries are adhering to that most. If you look at the Americas and the European Union, you'll find that almost 100% of the companies, they are going for limited assurance as per IC 3000. Whereas reasonable assurance, the red patch, and the moderate assurance, the even darker maroon patch, that is fairly low. And moderate assurance is somewhat prevalent in the Asia Pacific. But mostly, if you look at the larger, the developed nations, America, European Union, and all, they are going for limited assurance. And as I was telling you earlier, that limited assurance is the most preferred assurance standard, assurance criteria that is followed, mostly because of the time that is required, the effort that needs to get in, and the cost associated with limited assurance is much lower compared to reasonable assurance. Reasonable assurance can even cost 3 to 4 times of a limited assurance engagement or a limited assurance exercise that one goes in for. Yes, Neha, we can move to back to the reporting. Pratik, you can come in and explain the methodology and case studies, and then I'll come back again on the assurance method.
Thank you, Indra. So Mia, we can move to the first slide. Yeah. So we've talked about what a report is, why it's important. So I think now this portion of the presentation will focus on how we actually prepare the reports. So what you see on your screen is sort of a 5-step approach, which is a very standard approach to preparing your ESG disclosures. So as I mentioned earlier, the first step, of course, is doing a materiality review, also known as a materiality assessment or a materiality analysis. This helps companies in identifying what are the topics that are actually relevant to them from an ESG perspective. This then leads into the second phase. Once you've identified your material topics, then you need to identify your sustainability indicators under each of these topics. So, for example, if you've identified climate change as a material topic, then typically your indicators under that would be scope 1 emissions, scope 2 emissions, scope 3 emissions, your emissions intensity. Similarly, if you've picked diversity and inclusion as a material topic, then the indicators would be, the percentage of women in the workforce, percentage of women in the leadership team, percentage of people with disabilities that are part of the workforce. So those kinds of indicators. Uh, and this is the first and the most critical step in reporting, because this is not a one-time exercise. Generally, when companies report for the first time, they have to do this completely from scratch. But once they've done this the first time, then every year after that, they can build on it. They don't need to do it again from scratch. Even the materiality assessment is something that companies typically relook at every 2 years. And even then, it's not a complete redo, it's more of a refresh where they just do a quick review to see if there's anything that needs to be added, something that needs to be removed due to maybe some change in the nature of the business. And this basically forms the foundation of your reporting journey for several years to come. So identifying the material topics and then identifying the indicators and then aligning them with the appropriate standards, whether that be GRI, SASB, or TCFD. The third step, of course, is once you've done all of this, it's actually the process of data collection, which is, of course, the most time consuming and the most intensive part of the process. Typically, data collection templates or formats are prepared depending on the reporting framework you're using. So, if you're using GRI, then GRI based reporting templates are prepared and circulated to various functions within the organization, who then fill in the data as per the required formats and send it back to a central team, who then compiles all of the data, does it collation and an analysis of the data, double checks the data for accuracy and any kind of mistakes that may be there, and prepares it completely for the report writing, which comes in the next phase, which is basically once the data is collected, you analyze the data, you come out with trends, you come out with case studies, and then you basically draft your report. One very important critical part of drafting a report, and this has to be decided right at the start, is what is the boundary of my report. So, in many cases, there could be companies that have operations in multiple countries. They could be companies that have multiple subsidiaries. So they need to clearly define what is the boundary of the report. Does it cover all of my operations? Does it cover a part of my operations? And if so, which part of my operations? This has to be clearly mentioned. Reporting period is again something that has to be mentioned. So are we reporting for financial year 23-24, or are we reporting for calendar year 23 or calendar year 24? Sometimes companies even combine reports over two reporting periods. So, you can prepare a report for 2 consecutive financial years or 2 consecutive calendar years. But that period of reporting has to be clearly defined in the report. And then, of course, once the report content has been developed, it will go through a series of internal reviews and feedback gathering, post which the finalization of the report happens. And then the report is ready for publication. So, in terms of what are the key features of a sustainability report, any of us who have ever opened up a sustainability report and taken a look at it would know some of these aspects. So, of course, the framework or the standard that you've used, that has to clearly emerge in the report, whether that is GRI, whether that is SASB, whether that is integrated reporting. Um, Typically, the report also starts with the introductory message from the key leadership of the company, the CEO, CFO, maybe a member of the board, somebody who can basically talk about the ESG strategy and focus of the company at a very high level. Then, of course, the report consists of various disclosures on your social, environmental, and governance related initiatives and performance. It talks about various impact stories which can be presented as case studies. So, for example, if you've undertaken some sort of plant level initiative to reduce energy consumption, this can go into the report as a case study. If you've taken some kind of initiative, for community outreach or corporate social responsibility, this can also go into the report as so typically reports do have an entire chapter on CSR, and these kinds of impact stories are something that add a lot of value to any sustainability report, because one big difference between, say, a statutory financial audited annual report and a sustainability report is a sustainability report is not just a collection of facts and figures. There is a story that is being told. Sustainability reports typically have a theme, and all the information in the report is tailored towards that theme, because there is a message and a story that you're trying to tell people. Because the readers of these reports are not just investors, they're not just shareholders, they're also NGOs, they're academics, they're people in the government, and they're just normal lay people who have some interest in this area and who want to read your report. So in order to engage them, it cannot just be a collection of numbers and data. It also has to have a story and a narrative to make it actually impactful. Yeah, I think, Neha, we can move on to the next slide. Yeah. So Indo touched upon the principles of assurance when he was talking about ISA 3000 and ISA and AA 1000. But just as there are principles for assurance, there are also principles for report preparation. And for the sake of this session, we've limited ourselves to the GRI principles. Again, because GRI is sort of an umbrella kind of a standard, and most reporting frameworks draw very, very heavily from GRI. And even the principles that you see on your screen would be applicable to any kind of sustainability report, whether it is GRI or not. Of course, accuracy, this is obvious. The numbers that we're putting out in the public domain have to be accurate. Otherwise, there can be a lot of repercussions. I mean, if it's voluntary disclosure, there may not be any kind of compliance related repercussions, but there could be repercussions from society. There could be allegations of greenwashing. So companies have to be very, very careful that the data that they're presenting in the public domain is accurate and is verifiable. Balance. I think Indo touched upon this already. The information in the report should not present an overly positive image of the company. Now, of course, mature companies will have much more positive things to disclose than negative things. But at the same time, companies must strike a balance and must ensure that if there is some kind of negative performance, then that has to be disclosed accurately. One great example of this is generally when we see about safety numbers, we see about accidents and fatalities in the workplace. Uh, Earlier, when reporting was voluntary 10-15 years ago, a lot of companies would shy away from reporting those numbers, and or if the numbers were negative, they would find ways to sort of gloss over it. Whereas now, companies cannot do that. They have to disclose even the failures very, very clearly. Clarity, again, this goes back to what Indra was talking about in terms of understandability. The information must not be overly complicated. They should be understandable. Uh, the metrics should use valid units. They should be something that is easy for anybody with a basic understanding to interpret what it is that you're actually trying to say. Comparability, this is very critical. Comparability means that the numbers that you're presenting should be comparable to not only your performance as an organization year after year, but also comparable to some of your peer companies. So, if you are in the chemical sector and you're putting out an emission number, that number should be easily comparable to another chemical company in your geography, so that investors can then kind of assess what is the level of performance between these two companies in the same sector in the same geography. Completeness. This is also critical. GRI has a very detailed requirements of disclosure for each and every indicator. Sometimes companies don't disclose, the information entirely. Some portion gets left out. This is not a desirable thing. Um, uh, you know, ensuring that the disclosure is complete from the framework's perspective is very, very critical, again, to ensuring the credibility of the report. Sustainability context, uh, the information, again, since it's an ESG report, the information has to be sort of put into the context of sustainability. It cannot be presented like financial information. It needs to be contextual. Timeliness, again, is very critical. By this we mean that, if you are preparing a report for financial year 23-24, ideally that report should come out sometime by July, August, latest by September or 2024. There really should not be you shouldn't really have a gap of more than 4 to 6 months between the closing of your reporting period and the publication of your report. Because if it's longer than that, then the timeliness of that report is no longer valid. It's hard for people to then wrap their minds around it. If you're going to publish a report on data from 23-24 12 months later, then that is no longer comparable to other reports. And then, of course, verifiability. This again comes back to the principles of assurance that Indro was touching upon, that the information that you put into the report has to be verifiable. It has to be auditable. And this is linked to, of course, the first principle, which is accuracy. If you ensure the accuracy of your reporting, then the verifiability part of it automatically takes care of itself. Yeah, and this is typically the illustrative content of a report. Again, many of us would be familiar with this. So, typically what kind of information companies report on under, the broad chapters. So generally reports start with, giving a business profile of the organization, which includes information like the name of the company, where it's headquartered, where their operations lie, what is the nature of ownership and the legal form of the entity, and the markets that they serve. Then the governance section talks about the governance structure of the organization, including the ESG governance structure, the various associations that they be members of. Also it talks about how stakeholders are consulted with, what is the process of engaging with them. Under economic performance, we talk about economic performance. This is very different from financial performance. Economic performance talks more about the impact of the company, economic impact of the company's operations, on local communities, etc., etc. It also talks about things like anti-corruption. It talks about indirect economic impacts, like I mentioned. So, if if you're starting a factory in a new region, you would of course be generating new jobs. That would be a primary source of impact creation, but there would be secondary and tertiary areas. Because you set up a factory now, there would be more shops that would be opening, more housing that would get developed. So there is a large multiplier effect that comes into it. So companies generally disclose that impact under the economic performance sector section of the report. Under environmental stewardship, of course, we talk about our compliance. We talk about the raw materials that go into our production. We talk about supplier assessments. We talk about energy consumption, emissions. We talk about waste. We talk about water. Under responsibility towards society, which can also be known as corporate social responsibility, we talk about things like avoiding child labor, avoiding forced and compulsory labor. Our CSR initiatives aimed at improving the lives of the communities that live in and around our operations, and of course socioeconomic compliance. There is also a very critical chapter in all sustainability reports which focus on HR, which includes information on the employment nature. So, how many employees do I have by gender, by age group? So these disclosures are very, very critical. Having a non-discrimination policy in place. Disclosing your, like I mentioned earlier, your health and safety statistics, accidents, fatalities, near misses. Then also your human rights. Disclosures have to come in here. Then we talk about operational performance. So, what are we doing on our supply chain? How are we engaging our suppliers? Have we offloaded any suppliers due to negative ESG performance? what are some of our procurement practices. Then, of course, we talk about business sustainability. What is the management approach? What is our stakeholder engagement? What are the key concerns that were raised by the stakeholders? How these fed into our materiality process? And then finally, how we developed our materiality matrix. So typically, this what this slide is talking about is how reports are finalized when we work with different organizations. So there is a process, on our side as service providers, and there is a process on the client sides as well. So on the left hand side, what you see is, initially when we start the discussion with companies, we will conduct a report blueprinting workshop. So with the senior leaders of the organization, so we can freeze, what would be the reporting theme, what would be the overall messaging that would go in, what would be the tentative table of contents. All of that is finalized initially. Then, based on the materiality assessment, we support companies in developing the data collection templates, conducting training sessions for various functions on how to collect the data, how to measure some of the data, and then how to report some of that data back to us. And then, of course, we take all of that, we collate it, we analyze it, we prepare the draft of the report, and then this gets sent to the client at multiple phases for their review and for their inputs. And what you see on your right hand side is some of the key ideas that you want to communicate in a sustainability report. So, like, company is committed to delivering on its purpose and using its influence to have a positive societal impact. The company's approach to integrating ESG within its business strategy. How it is acting as an engine of growth for the local socio economy. Like I mentioned, when you set up a factory, there is a multiplier effect. You're not just generating jobs for your direct employees, you're generating a lot of indirect jobs and value creation in local communities. You need to highlight how socially responsible initiatives are helping local communities, and you can achieve this by creating a unique report structure and flow that highlights the company's story and journey, while at the same time aligning it with the reporting frameworks. Developing a storyboard and highlighting relevant case studies, again, like I mentioned, is very, very critical. This should not read like a collection of data points. It should read like a story. And then of course supporting narratives or testimonials. So in very good reports, you will see that there are often cases, testimonials, and quotes that come in from their employees, their vendors in some cases, some of their other stakeholders like shareholders, even regulatory people provide comments in sustainability reports. So engaging those stakeholders, getting their testimonials, again, adds a lot of value to any sustainability report. And again, like I mentioned, balancing between thematic flow of the report to ensure readability and relevance, and the data. So with it, just because you're trying to tell a story doesn't mean you need to lose the focus on the data. The data still needs to be accurate, it still needs to be robust, but at the same time, it should be balanced with a theme and a story to make the report more readable. So this is again, what I'm trying to show through the slide is that, there has been a lot of evolution when we talk about sustainability reporting frameworks and metrics around the world. Uh, I don't want to focus too much on the long journey over the last 30 odd years, starting with GRI in 1997 and then culminating with the EU CSRD in 23-24. But just to summarize it, that yes, over the last 30 years, a lot of reporting frameworks have come in, and some of them for, full-fledged ESG reporting, some of them for certain aspects like climate change, or water consumption, or wildlife, or nature, or biodiversity. But the point is that what has happened due to this is that there is a lot of confusion amongst companies, because there is no real clear direction in terms of what standard of framework any one company should adopt in order to report their performance. Most companies, as we mentioned, have used GRI as a catch-all kind of a standard, but a few years back in 2022, IFRS, which is the parent body for developing reporting standards, both financial and non-financial, took it upon itself to try and consolidate some of these myriad standards into one common global standard that can be applied by any company in any sector in any geography. And in order to do this, they have engaged very closely with some of the leading standards in the world. So GRI, of course, is a key stakeholder in this. TCFD is a key stakeholder in this. CDP is a key stakeholder in this. SASB is a key stakeholder in this. And all of these entities have come together and worked with IFRS to feed into what we know as the EU CSRD, which is the corporate social, the sustainability reporting directive that is now applicable for all or will be becoming applicable for all EU companies starting from 2025. And this is actually linked to ESRS, which is the European Sustainability Reporting Standards, which actually provides the set of material topics and metrics that can be used for reporting. And like I mentioned, these metrics are again derived and adopted from the various global standards like GRI, TCFD, CDP, SASB. So I think very soon in the next 2, 3, 4, 5 years, I think the confusion over which standard to use, I think will slowly go away, because this global standard will kind of become, what is applied globally. And if you move to the next slide, Neha. So you see a bunch of standards on on the slide, but I will start with S1 and S2, IFRS S1 and S2. So IFRS earlier this year on the 1st of January released their first two consolidated standards, S1 and S2. There are more standards that are in the works and will be coming out soon. S1 talks about conducting a double materiality analysis and identifying the financial impacts of these material topics and disclosing them. And IFRS S2 is basically a replacement for what used to be TCFD. So under S2, it talks about climate change impacts on the organization, the risks, the opportunities, and you have to disclose those information under S2. So these are the first two IFRS global standards that have come out. But like I mentioned, more are in the works and more should be coming out. GRI, of course, we've discussed at length and we have a more detailed slide later on, so I will hold off on that. EFRAG, of course, the European Financial Regulatory Reporting Advisory Group, is the entity that has created both the CSRD as well as the ESRS. And SASB, like I mentioned, is another reporting standard which was initially very popular in the US, but is now growing in popularity globally as well. Since it does, GRI does have a couple of sector specific standards, but GRI generally is considered to be a sector agnostic and a geography agnostic standard, whereas SASB is very sector specific. There's 77 sector specific standards, and depending on which company or sector falls into, you pick that standard and you prepare your disclosures accordingly. CSRD we've already discussed. CDP, of course, is a leading framework for reporting on your climate related, water related, and nature related impacts. So it started out with climate change, reporting on your scope 1, scope 2, scope 3 emissions, reporting on your climate related targets, reporting on your internal carbon pricing, all of that. But a few years ago, they added a module on water as well as a module on biodiversity. And of course, IIRC provides you with the framework for integrated reporting. So yeah, just to give you an overall overview of the GRI standard, since it is the most commonly applied framework in the world and sort of the parent umbrella standard, GRI has gone through a lot of evolution over the last 30 years. It started out with GRI 1, G1, then it moved to G2, G3, G3.1, G4 in 2014, and then finally in 2016 they decided to convert it. In 2020 they decided to convert it into a standard, or call it a GRI standard. And now some of the rules have changed. So if you're now applying the GRI standard, you need to notify GRI officially that you're applying the standard to prepare the report, where earlier you didn't need to do that. So some of those operational things have changed, but overall the structure doesn't really differ much. There is one section on environmental disclosures, one section on general disclosures, one section on social disclosures, and then one section on your governance related disclosures. As I mentioned earlier, there are also certain sector specific disclosures on GRI. So right for now, we have one on oil and gas, we have one for coal, we have one for agriculture, aquaculture and fishing, and we have one for mining. And there are other sector specific standards that are under development. But this is not really the key focus of GRI, because as I mentioned earlier, GRI is more looked upon as a sector agnostic standard. There are now two ways to prepare your report under GRI, in accordance and with reference to. In accordance has very stringent requirements. It requires a third-party assurance of your report. There are a lot of mandatory indicators that have to be reported on, whereas with reference to is much easier to report on. It doesn't have mandatory assurance requirements or any indicators that mandatorily need to be reported. So most companies go in for the second option. But yeah, the mature companies are the ones who are publishing reports in accordance with the GRI standards. So yeah, Neha, we can move on. So this is a case study of some East African companies that have been publishing sustainability reports for several years and are very mature reporters and provide extensive disclosures in their reports across ESG. So Bamburi Cement, of course, is a leading clinker cement and concrete producer in Eastern Africa, and they have been reporting for several years. And as you can see from the snapshots on your screen, the reporting covers various aspects: climate and energy. It talks about people, human rights. It talks about compliance. So it covers a whole gamut of information that is relevant to them as an organization. And Bamburi, of course, being a cement company, cement is a sector which is very, very environmentally, what should I say? There are a lot of environmental impacts because of the cement manufacturing. So reporting in the cement sector is very, very critical. And cement companies as a sector are some of the leaders globally when it comes to sustainability reporting because of the scrutiny that has been on the sector for several decades. And this is another leading company, KCB Group, which is a financial institution in Kenya and East Africa, and they also have been reporting for several years. We wanted to highlight that they've adopted the SDGs, so they are preparing GRI-based reports, but they've also linked their GRI-related indicators to the UN SDG goals. So they're disclosing information that, like I mentioned earlier, companies now tend to combine frameworks for reporting, and GRI plus UN SDGs is a very common linkage that we see. And KCB has been doing this for several years now, and are one of the leaders in the region when it comes to reporting on SDGs as well as providing GRI-related non-financial disclosures. I'll now hand this back to Indro to take us through the assurance process.
Thank you. Thank you, Pratik. And now, after looking at the entire reporting methodology and some of the case studies, I'm sure that you all must have felt that many of the assurance aspects are already covered in the reporting. So the moment we get into assurance, it is actually quite dependent. The outcome of the assurance will be highly dependent on the quality that we have been able to ensure during the reporting process. While an assurance provider will refer to maybe some of the standards like IEC 3000, AA 1000, they'll apply certain principles, they'll be doing some audit trails, but all is well if we have practiced and we have followed the principles that Pratik shared. We had taken care of all the appropriate forms of stakeholder consultation throughout the reporting process. We have tried to collect data from the right sources and put it in the right place, use the right factors to convert data into the right form. So if we are sure of that, then the assurance provider doesn't have much to do. It's just a cakewalk, and assurance provider gets happy very soon and provides a very clean assurance statement for the disclosure. Coming to the methodology of assurance, this is a very typical methodology that is provided in this particular slide that you're seeing. This is written reasonable assurance of integrated report. But typically, the process, whether it's a limited assurance, whether it's a reasonable assurance, typically the steps are the same. So the first step involves what exactly in the disclosure should the assurance provider look at. So creating a checklist of assurance is the step one in the entire assurance process. And that's what one has to do the moment an assurance provider is appointed for assuring a particular disclosure. And the appointment process is also critical because as a reporter, you need to also appoint the right assurance provider. And in the standards, it is very clearly defined how the reporter needs to kind of choose the assurance provider for the purpose of assurance. So that's also a specific methodology that they have defined clearly. And you'll have to look at the qualifications of the assurance provider. You'll have to look at the team of the assurance provider. You'll have to look at the time that the assurance provider is assigning to the particular assurance exercise. So all these things need to be checked at the reporter end. And once the assurance provider is on board, the first task the assurance provider is going to do is going to take a look at the consolidated data set and the may not be the final report, but the draft of the final report that should be ready at that stage. Once the data and the information are compiled, it may not be designed, but at least the set of information, the set of statements are all finalized. At that stage, the assurance provider will review that and create a checklist of information that the assurance provider will need to check on, will need to do an audit trail on. So that checklist becomes plays the most critical role in the entire assurance process. So that checklist will be the reference point for the assurance provider for all the teams that will be coming in to conduct assurance across the different operations, across the different functions. So that remains as the Bible and that remains as the reference point for the assurance provider. And that is sometimes it is also shared with the different functions of the reporter, of the reporting entity, in order to facilitate the assurance. So that goes out as a heads up to the different people inside the reporting organization so that they are aware that these are the information that will need to get checked and so that they can get the evidence trails appropriately in place to provide confidence to the assurance provider, just to speed up the process and facilitate the process. In some cases, of course, there are surprise audits also that happen. So a select sample of information may not be always there circulated to the reporter or circulated to the reporting entity. And the assurance provider can actually look into any and other data that he feels, that the assurance provider feels is important to gain confidence on the information that the reporter is sharing in the report. So these are the steps. So one includes the review of the report and the data. After the review comes the site selection and the selection of sample data that will be audited and the audit trails will be conducted. Post that comes the actual in-person or physical audit of some of the information and data. In some cases after the pandemic, both at the assurance reporter level as well as the assurance provider level, there are certain modified ways of doing some of the assurances on a virtual mode. These are working out, but this is only for limited assurance that virtual audit is working out. For all reasonable assurance, where the evidence gathering process and the review process is much more in detail, there it cannot be. We do not suggest to go for any kind of virtual mode of conducting reasonable assurance because that does not give you the complete picture. Unless one does a complete walkthrough of the plans, of the processes, of the sites and the facilities, it is not possible for the assurance provider to gain confidence on the checks and balances, on the controls that our organization would be having. So for reasonable assurance, it is always recommended that the assurance provider conducts a physical in-person audit of maybe a select sample, maybe 70–80% of the material contribution coming from the plants that needs to be audited. But there needs to be some kind of a physical check that also gets conducted for reasonable assurance. For limited assurance, many of the organizations choose a mix of virtual as well as physical audit, which can work out still for limited assurance. If we move to the next slide, ma'am. This is a very typical kind of illustrative showing the flow of information and data and how the entire assurance process gets completed in the, what's the different steps that are conducted. So it starts off with the reporters team, which is actually the core team on reporting, who has actually compiled or consolidated the report at a corporate level. They prepare the entire consolidated reporting sheets. It may be in Excel files also. And if the draft report is ready, the draft report, the statements and claims, that gets passed on to the assurance provider team. Now, from there, it moves up. There is a review conducted by the assurance provider, and post that review, it moves into a second stage where the assurance provider passes on a preliminary set of feedback or observations, which comes to its notice from a review of the initial set of information that the assurance provider has received. Once the reporting, and now it has gone back to the company which is reporting. Now, once the company again receives all this feedback, the first set of feedback, it may be able to fine tune some of the things. It may be able to do some corrections here and there, which are not major, but at least to set the house in order, set the report in order, it can do something. Post that, there is a physical check or some of the select sites are visited by the assurance provider to conduct a on-site physical audit, particularly for reasonable assurance, to cover most of the sites which are contributing to 70-80% of the footprint or 70-80% of the data. Once that is over, the assurance provider's task is over, and it will wait for the final report to come in. And once the final report comes in, there is one set of final review at a desk level and a review with the corporate team, post which the assurance provider will submit a management letter, which is a feedback letter to the company which is preparing the report. The feedback letter gives a complete set of gap analysis and a set of recommendations for going forward. In the future years, what kind of initiatives need to be taken up by the organization in order to close out on all the gaps that has been identified. That kind of a document gets submitted, and post that, there is issuance of the final assurance statement also on the final report that gets submitted to the assurance provider. So this is the typical flow. It changes based on the situation, based on the reporter and the assurance provider. There are some subtle changes that keep on happening in the entire process. So one assurance provider might be following this process. Some other assurance provider may bring in some changes, but broadly, if you see, this is the entire process flow of assurance, and this is how it takes place in most of the occasions for non-financial assurance. Mia, if we can move to the next slide. These are some sample assurance statements that you're seeing over here. So this is a typical statement that you find, which clearly states the reporting guideline that has been followed by the reporter. What is the assurance standard? What is the scope of assurance? And what kind of limitations are there in the entire process? So particularly in this non-financial assurance, there is a standard limitation that will always be included, that the assurance provider has not looked at any financial data or information which has been presented in the report. So this is a complete non-financial assurance. The assurance provider will absolve itself from any kind of liability or responsibility of assuring the financial data. Particularly for integrated report, the financial data gets audited by the financial auditor. And in some cases, the financial auditor and the non-financial auditor are different. So the non-financial auditor is going to keep itself away from validating any of the financial data or information that gets captured. In many cases, there are certain ratios that are presented, particularly intensity ratios and all, eco-efficiency ratios that get presented, where one of the data, maybe the numerator is a environmental data or a social data, and the denominator is a financial data. In those cases, the assurance provider will clearly limit its scope to assuring only the numerator part or the non-financial part, while it will state that it is assuming that the financial part has been drawn from audited financial statements. So that way it will limit the risk of assurance only to non-financial data. It will not get into assuring any of the financial information that gets captured. Apart from these three, there will be a section on observation and the conclusion. Along with that, there will be a paragraph on independence. So these are very standard things that needs to be included as part of a standard assurance statement following the IEC 3000 or AA1000. We move to the next page. Yeah. This is another sample. Now, here you will find this is mostly following the IEC 3000. So assurance statements can be both following IEC 3000 as well as AA1000. The moment you take a look at a AA1000 assurance statement, it will be capturing assurance opinion based on those 4 principles of inclusivity, responsiveness, materiality, and impact. Move to the next page. Yeah. This is one important part, which is a management representation letter. So an assurance provider will always issue its signed assurance statement once the reporter or the reporting entity has submitted this kind of a management representation letter, which is nothing. It's a very simple letter, a declaration from the reporter that whatever evidences, whatever information that they have submitted, they are true and they are appropriate and they are correct, and that kind of a declaration, which it is an obligatory thing to be submitted by the reporting entity to the assurance provider. We can move to the next page. Yeah. These are again some of the data points, and you will find the assurance report on the right hand left, on the right hand bottom corner. And here on the left, you will find some of the non-financial performance parameters. So what in the process of assurance, what is done is you provide opinion on all these data points that are there, which are non-financial performance data. And this provides a huge amount of confidence on the reader that whatever data has been presented, whatever performance parameters has been presented on non-financial count, it actually holds, and there is a backup or a evidence trail or a process behind each of this information that has been presented by some of these companies. We can move to the next page. This is another sample, again, assurance report to the ESG scorecard, or maybe something which is disclosed on the SASB or TCFD index, highlights of ESG performance presented by a company. So all these things can be assured by an external assurance provider, and all it will be looking for is an audit trail of each of these data and numbers and the qualitative statements also, what kind of backup evidences you have. So if you're stating some claims or something, we are the best, or we are the first, or some kind of a very, very qualifying statements, if they are presented in the report, it has to be backed up by solid evidence. Unless it is there, the assurance provider will have serious observations about that, and they'll probably ask the reporter to remove those sentences from the report before it issues the assurance statement. Similarly, for quantitative data, it will be looking at all the logbooks, it will be looking at all the processes of transmission of data, it will look at some of the software downloads like SAP download and all that they'll be looking at, and they'll check on the consistency of data, the process of data, the methodologies that has been kind of adopted. So everything is going to be checked by the assurance provider, but definitely on a sample basis. If we can move on. Yeah. This is another example of a assurance report which is there for Schneider. So I think it will be a repetition. So whatever is the report, the assurance statement's purpose is to provide credibility to the disclosures in this particular non-financial report on all the indicators or KPIs that are agreed. Now, let me tell you one thing, that in the scope itself of assurance, it can be very clearly defined on what exactly the assurance provider is supposed to look into. Now, as a reporter may decide that I will get only 3 or 4 of my 100 indicators to be assured by an external provider. So that's a choice that is there. At the same time, it is advisable to cover all the material indicators or material information for that particular organization. Suppose a company may be a highly energy intensive industry like cement or steel and all. They should definitely report on energy and emission. They cannot actually ignore that particular indicator. Similarly, a water consuming industry like, say, a beverage company or similar, they have to report on water and what are the kind of initiatives they're taking up on water. Similarly, some say textile or some other sector where there is a huge amount of social issue, human rights issues in the supply chain. They cannot ignore that. They'll have to capture that and report that. And ideally, the assurance need to be there on all these material indicators for that particular organization and that particular sector. Otherwise, assurance may be treated as just a eyewash, as was mentioned earlier, as a greenwash. I mean, see, there was an assurance statement, but the assurance statement doesn't cover some of the things which are material for the business. So that doesn't carry any meaning. Let's move on. Yeah. Yeah, this is one more example where we can move on and we can actually move towards the close. I don't think we have too many more slides to see. We can move into the question section, and I would like to pass it on to Meha, Zahir, to bring in some closing comments from your end, and we can have questions from the audience, which we can always respond.
Thank you, Andrew. And thank you to all our other panelists, Zahir Sheikh and Prateek Gupta. Thank you so much for this very insightful webinar. We actually do have a few questions that we can run through. So the first question is, how do you evaluate current regulatory requirements towards reporting ESG information? Is this purely optional and based on the willingness of reporting entities, or something that is becoming a mandatory disclosure?
Let me respond to that, Pratik, you can add on. So for evaluating regulatory requirements, I would like to understand the question better, because if there is a regulatory requirement, that becomes a mandate on an organization. So wherever there is a regulatory requirement, that's an obligation for the organization to respond to that and report around that. There is no option. So if you are not reporting in that case, it's a violation of the law, the land.
Yeah, and just to add on to that, I think reporting in most geographies still today is still voluntary, but this is changing. Not only say in India now, we do have very strict mandatory reporting requirements, also in Europe, North America, but also in East Africa. You would have seen, we talked about the Capital Markets Authority, we talked about security, the stock exchange requirements. These may be voluntary for the time being, but just like in any other country, including India and Europe and North America, they start out as voluntary and then become mandatory in a few years' time. So it's sort of better to stay ahead of the curve and start reporting when it's still voluntary and the risk of reporting is low, than wait till it becomes mandatory and you increase your risk of reporting.
Thank you. We have one more question, which is there a standard report size, and how big should the report be?
Typically, reports are, from what we've seen, I mean, they can vary vastly. I mean, I've seen reports that are 30 pages long and then reports that are nearly 200 pages long. But typically, 70 to 80 pages is, I think, what the standard best practice is. Indro, if you would like to add something to that.
No, I think that's absolutely right. And that's what we're seeing. Most reports come to that kind of a size, 60 to 80 pages. And that's a good size of a sustainability report.
Okay, thank you. So that's all the questions we have today. Once again, thank you all for joining us, and a special thanks to obviously BDO in India. Thank you, Indra Guhu and Prateek Gupta, for helping us and collaborating with us, and also the previous panelists that helped us, Dipankar Ghosh and to Rini Sahu, for joining us in the previous webinars. And I'd like to hand it over to any of the panelists who want to give some closing remarks before I send out a feedback survey that we really hope that you guys take some time out just to give us some feedback on this whole webinar series, and then help us plan future webinars with BDO in India. So thank you.
Nothing to add from my side, Zahir.
Well, all I want to say is thanks to the Indian team. You've come through and you provided some excellent advice throughout the series. And sure, the clients, all the people who attended from East Africa, greatly appreciate your expertise. And we're looking forward to a lot more collaboration with you guys, as we develop our own ESG expertise as well. So thank you, and highly appreciated.
Thank you. Thank you.
Thanks
Yeah.
to everyone for participating.
Yes, thank you all once again. So the poll is out, so please take some time out to fill it, and then we'll get back to you on the next webinar series that will collaborate with BDO in India. Thank you.